All right, want to talk to you today about your entity when you're in business. So this is for business owners, but if you're going to be getting into business, this is the stuff that you need to know that they don't teach you in Harvard Business School. Maybe they do actually. I don't know. I didn't go to Harvard Business School. All right, so here's your entity progression. So we got two progressions, possibly a third, but let's talk through where to start because I see so much misinformation online where people are like, you need to get your LLC set up and you need to get all these loans and you need to get bank accounts. You don't need to do any of that. You need to get customers and sales and make money. And under most circumstances, your best option for doing that is as a sole proprietor. Quite simply, simplest form of business, most common, most heavily audited, but we'll get to that in a minute. The numbers are still really low. But it's a great place to start because you are the business and the business is you. So there's no differentiation. So you can literally have the same checking account that you deposit your salary from your job in and put all your side hustle money and expenses. Your bookkeeping team and your tax person will hate you at the end of the year, where if you do it yourself, hate yourself. But that's legally allowable because there is no distinction between you and the business. And why this is a good idea is because when you get started, corporations have something called basis. And basically, all it means is basis is what you put into the company. You can't pull out more than your basis. If you do, it just kind of sits there. You can't take those losses against your W 2 income. And you're a little limited on your initial startup costs before you're getting in business as a sole proprietor. But once you're up and running, if it's a legitimate business expense, and we're going to do another video walking you through the most commonly missed business deductions. But the sole proprietor is your way to go because you can have losses on your Schedule C, which is what this gets filed on. It's just part of it, again, because it's you, it's just filed on your personal return. And those can offset your other W 2 wages and kind of even each other out and help give you some funding, give you some tax savings to help get the business started and kind of up and running. Why is the IRS, by the way, interested in your business being profitable? By giving you deductions to get it off the ground? Real simple. Because if you're successful, you're going to pay a lot of money in taxes over your lifetime, although you can control that by being strategic. But also, you'll provide jobs, you'll stimulate the economy, you'll buy a bigger house. So the IRS is willing to partner with you while you're getting this whole thing up and running within reason. And again, you're entitled to any legitimate business expense. And because they're the same, there's often an overlap where you can write off some things that you're already spending money on and keep those things and turn around and go from there. So again, it helps you get started because you don't have any basis rules. It's easy, it's fast. But now, once you swing from negative down here, so let's say here's the zero line, and when you're getting started in business, and I used red ink for a reason because you're losing money. And again, some of it may just be writing off stuff you're already spending money on. Hopefully, there should come a point where now you swing profitable. And now, once you get in here, as a sole proprietor, now you get some challenges. Because what happens is all of your income is subject to self-employment tax. What is self-employment tax? Well, when you work for a job for an employer, you pay half, that's your Social Security and Medicare tax, and they pay half. When you're in business for yourself, you pay all of it. So they do give you a couple of extra deductions for it, but you're responsible for all of that tax. And it goes up to about 170,000 and it's about 16%. So 170,000, that would be 17,000 at the 10. And let's just call it 5, make my life easy. We'll call it another 10. It's about 27 to 30 some odd $1,000 in taxes is where it maxes out. Well, again, over a 10 or 15 or 20-year window, that's a lot of tax because, again, you're paying both sides. Said before, Social Security and 401ks are great under the same circumstances when someone else is paying half of it. If you got to pay the whole thing of both, then they're not quite as attractive. So now, once you swing here and get profitable, now we move down here to getting some sort of entity. So I'm going to give you two. The most common one is this one. Doesn't mean it's the right one. It's just the most common. It's an S corporation. Now we've separated you from your business. So we've got a separate return, separate bank accounts, all those sorts of things. Hopefully you had separate bank accounts anyways, just to make your life easier. Separate credit cards, separate everything. And now what an S Corp allows you to do is to separate your income into salary that you pay yourself as an employee of the business for the work that you do as an employee. And that amount, the S Corp pays half the Social Security tax. You as the employee pay half, but really you're both, so you're still paying both sides of that. But you can split that up and have part of your compensation come in owner draws. The owner draws you're still going to pay federal and state tax on, but you're not going to pay self-employment tax on. So now let's go back to my example. If it was $30,000 here in self-employment tax because you'd reached the top of the threshold, and you step in and you're making 160, let's call it here, and you come down here and you pay yourself 80,000 in salary and 80,000 in owner draws, we cut that 30,000 in half. We saved about $15,000 in taxes roughly. So that's a huge improvement. Now you will get a slightly lower Social Security payout, but we saved a lot of money along the way, particularly if we're doing this over 10, 15, 20, 30 years. Now there's another alternative. And we're doing a whole separate video about this because this one's new, but it's a special LLC, and it's a structure that's modeled after limited partnerships, but it's for actively run businesses that you're doing. And what we do here is basically the Social Security portion, taxable portion of it, is set at 1/10 of whatever the gross net revenue is. So if it was 160 up here, and we paid 30 and it was 80 and 80 salary, 80 owner draw here. So we cut the 30 down to 15. Over here, it would be 16,000 of actively earned income, and the rest, the 144, would be passive income. So now your Social Security would go down to about $3,000. So massive savings. Now we're in a $27,000 savings from where we started out, again, if we were at that upper end of what a sole proprietor does. Hopefully you'll institute an entity before you actually get there to save that money along the way. But that's something you want to chat about, you can reach out to us about, or make sure to subscribe. I'll remind you again at the end of the video so you get alerts as we talk more about this and what it takes to get set up. And takes a little bit of work to get it set up, and it's a little less common than this, so it's going to be a little more expensive, but you're going to save a lot of money over here. And if you just got to realize now we've greatly reduced your Social Security payout. We're essentially almost opting out by means of this. So you've got to be disciplined and put that money aside somewhere else, but you get to retain control of it. And let's face it, government can change the Social Security rules anytime they feel like it. Last one, C Corporation. So these are pass-through entities. Everything flows through and goes over on your personal return. Same with partnerships. They have their own unique challenges. We see those less common. But down here, a C Corporation is not a pass-through entity. It's a closed entity. What that means is you don't get the option of taking money out of it through owner draws. You can only take money out through salary or dividends. The trick is dividends are taxable to you, but they're not deductible to the corporation. So the corporation pays tax on that, and you pay tax on the dividends. And then later, if you go pay that same dollar again to yourself in salary next year, you get to pay tax on it all over again. And that's where you hear about corporate double taxation. Why would someone do this? There are some advantages, but we'll go through a couple. The first one is if you ever want to take a large number of investors or overseas investors, these other entities aren't really set out for that. There can't really be, I mean, you can have friends and family throw you money for a sole proprietor, but they can't have stock. There is no stock because the business is you. Down here, we can have a handful of owners, but there's some rules on where they had to be born and stuff. Here, doesn't matter. So if you're taking investors or you want to go public, you're going to need a C Corporation. You can't do it up here. But here's one other advantage, and that is if you're going to sell the business, and the key number here is 5. Cinco. Because if you've owned a C Corporation for 5 years, actually the key numbers are 5 and 10, You can sell it for up to $10 million of profit and you pay zero capital gains tax on it. So that's a game changer right here. So again, what a lot of clients will do is we'll marry, if you're thinking of selling or taking investors, we might marry a C corporation to an S corporation or a C corp to one of the special LLCs. So we can have the tax-free sale, take some investors over here, those things, and then we kind of pass money over here and run it through here so we can avoid some of the other issues. But this is complicated stuff, but if you get it right, we haven't gone into what you can write off or any of those sorts of things. If you get it right, this is one of the many ways. I've talked previously about the 5 areas that we find money for our clients: taxes, mortgage, retirement, where that and how they set that up, education, and major capital purchases, anything you can't pay for in a month. But taxes will be your biggest one if you're successful, because kids grow up and leave house. You stay in the same house. Eventually, a mortgage gets paid off. At one point, you do retire or you don't, your choice. But taxes will always be there. So we want to mitigate those along the way, but not set ourselves up by deferring everything to the future, because Congress can raise tax rates. And then when you go to pull out of your SEP or your IRA or your 401k, you can get hit there. That's another video for another day. Here's what you want to keep in mind. The best place to start, unless you have heavy liability, like bunch of teenagers, you open a pizza shop and you're going to have your own drivers and not do Uber or DoorDash, and you're going to have your employees driving around while who knows what drugs they're on or what they're looking at on their phone when they should be focusing on the road. We want to skip to one of these for liability. But absent a big liability or taking on a bunch of investors early, I generally recommend start with a sole proprietor, move into one of these entities. I like this one. And then later, if you're going to be selling or getting more investors or anything, we can talk about a C corporation. But that's your entity progression. C, Schedule C, sole proprietor down here, entity once you go profitable. So this isn't overly complicated, but there is more to these decisions than just checking a box or doing what your neighbors or friends do. So be sure to subscribe to our channel where we post updates and keep you up to date with the latest in finance, the best practices for running a business, paying the least amount of taxes. And don't forget, we're around. If you want to chat with a member of my team, you may get me, you may get one of my team members. They're all heavily trained, they're friendly, they're easy to work with, and we're across a bunch of different time zones. So just reach out to us, but definitely make sure you subscribe so you can get the alerts on the updates, and we will look forward to chatting with you soon and seeing you on the next video. Hope you learned something today.